miles north of San Diego, nestled snugly along the Pacific in the little town of Del Mar, you'll find one of the world's most beautiful racetracks. One whose history traces back to the golden age of Hollywood, where one celebrity's labor of love gave birth to an idyllic summer playground that would grow to become known as where the turf meets the surf.
Del Mar was a product of Hollywood. It was an idea that Bing Crosby had. He and a few of his buddies from Hollywood put up a little money and built a racetrack. Bing was a marketing guy. So opening day was, hey, come down and see the stars.
Can you imagine going to the races and seeing Desi Arnaz, Lucille Ball, Jack Dempsey?
The great Bing Crosby, here he was, this huge Hollywood celebrity out there in the front of this beautiful facility, grabbing tickets, ripping tickets, letting people in, greeting people to come in.
It was the scene. It was the hip place to be.
Where the turf meets the surf, down at old Del Mar, take a plane, take a train.
People wanted to be here at Del Mar. J. Edgar Hoover would come out every year. He'd tell his cohorts back in Washington that he was coming out for a physical. Well, you know, that took 10 minutes. Then he'd be out here at the track every day. You hit the ball out of the park the first year. The second year, all of a sudden you decide, let's get Seabiscuit out here and let's have a match race. So Bing, who had a horse he brought up from South America, Ligarodi was his name, and so they had a match race. Bingo. Kind of went from where the turf meets the surf to Del Mar as cool as ever. That's where we started, and it's been a labor of love ever since. The Del Mar meet runs basically from early July through Labor Day.
It's unbelievable. I've been coming to Del Mar since 1975. It always had this magical allure. Del Mar opening day is electric. There is nothing like it. I mean, horse racing here is the hottest ticket you can imagine. And everyone comes there. It doesn't matter, you know, Drew Brees is here, Jim Rome is here. I mean, everybody who is anybody is here and probably in that turf club. I just don't feel like getting dressed up.
When you first come to Del Mar, you look, the first thing you see, these beautiful black and white old pictures.
One of the coolest pictures I've ever seen, to see the great fighter Jack Dempsey, you know, with the jocks behind him and stuff. It was incredible, and that still gives me goosebumps to see somebody of that stature that was here hanging out with the jocks. Doesn't get any better.
All my good horses have always come through Del Mar. From Seabiscuit, Native Diver, Zenyatta, Silver Charm, all the greats, they've all come through Del Mar.
There's nothing like the history in Del Mar. I feel so blessed to be in this paddock where some of the greatest in the world have been. You know, shoemakers, Johnny Longnett and Lafitte Pinkai. I mean, the list goes on and on and on. And just to be one of the riders that still getting that opportunity is a true blessing.
It has become the mecca of summer horse racing.
Good luck today.
This is 7 weeks of heaven.
I just feel very humbled to hopefully continue the legacy here. In 2017, when the Breeders' Cup is actually going to be here, I mean, who would have thought? I'm sure Bing Crosby's looking down, smiling.
Ladies and gentlemen, please welcome the Thoroughbred Owner Conference Master of Ceremonies, Tom Durkin.
You do see the resemblance, of course, between me and Bing Crosby. I must tell you that I am in no way, in no iteration whatsoever, Bing Crosby. I cannot sing like Bing Crosby. I don't really even look like Bing Crosby. I certainly don't have Bing Crosby's money. But today I am an homage to Bing Crosby. He's one of the reasons that we're here at Del Mar 80 years later. He's the guy that got the Del Mar ball rolling, him and some of his Hollywood buddies, Pat O'Brien, Jimmy Durante, oh gosh, who else? Oliver Hardy of Laurel and Hardy fame. And make no doubt about it, though, Der Bingle was the main man. And the mantle of the main man has been inherited by the current CEO and president of the Del Mar Thoroughbred Club. And he's here to welcome us to Owner View, the fourth Owner View. And he's here to welcome us to, for the first time, the Breeders' Cup, where the turf meets the surf at Old Del Mar. Ladies and gentlemen, Joe Harper.
Tom. Thanks, Tom. You do look a lot like Bing.
Well, thank you very much.
On a bad day, but you look like Bing, you know. You know, Bing, it's funny because, believe it or not, Bing and I were in the same movie together, and I had a bigger part. My part, I called it a two-sneeze part. If you sneezed twice, you missed me. If you sneezed only once, you could see me. And it was a circus picture called The Greatest Show on Earth. And it won the Academy Award for Best Picture of the Year in 1952. I think we shot it probably mostly in 50 and 51, because I remember being 7, and that would have been about right, 50, yeah. And so the interesting story was that because Bing played himself in the movie, and it's a circus picture, and the camera pans the audience while the high act is going in, so everybody's looking up, and they pan the extras and stuff that are looking at the audience, and then they pan right by Bing Crosby and Bob Hope, but they don't slow down for anything. They just, you know, go on. So it was probably maybe max a second and a half. So I kidded him when he came down here the year he died, and I talked with him for a while, and I told him, you know, Bing, I got a better part than you did in that movie, but my pay probably wasn't the same. He said no. He said, I didn't get a cent, not 1 cent. He said, I just showed up because your grandfather told me to come. So he was a interesting guy. Bing, you know, he was a great singer, but an actor, but he had something a lot of other people in Hollywood didn't have. He wasn't owned by any one studio, because Bing was I think the studio heads figured, oh, this guy, we can't really sign him up too tight because he can go sing and make records and make more money probably than we could. So Bing had some good power in Hollywood. And I'll tell you a story. Bob Hope told me, Bob Hope used to come down here quite often late in years. And I said, what was the deal with Bing and you? And as you were pals. And he said, I'll tell you one thing. He said, when Bing Crosby said, show up down here, we showed up. Because he had a lot of power in Hollywood, which I never really realized. And so they were always clowning around. Well, one night, Saturday night, they were clowning around on the piano with Jimmy Durante and singing songs. And when they stopped, the audience kind of liked it. It was just, you know, the Turf Club members were there for dinner. And so he said, you know, we ought to do this, make a movie. It's working out, you know. And so that's where the road pictures they made, like, I don't know, 4 or 5 of those road pictures are all very successful pictures. But at least it had a start right on the Turf Club patio at Del Mar back in the 30s. Another thing Bing did for us, you know, Bing was, he was a good singer and actor, but he was really a pretty good marketing guy. I mean, it was his idea to call C.S. Howard and get Seabiscuit out here. I mean, it was a phony match race. You know, most match races are probably. But, you know, they're marketing tools, not necessarily who the best horse is. I think the tracks look at him as a crowd pleaser, and that's about it. But Bing, you know, with Seabiscuit, who was getting more press in those days than any athlete in the country, and even more, you know, inch space, column space than the President of the United States. So, wish it was that way now. Anyway, so can't we come up with a horse that, yeah. Anyway, I think that when that happened, it kind of kicked off. That was the second year of Del Mar, and it kicked it off. But these were the days before television. These were the days, you couldn't see a star anywhere except in the theater on the screen. So, you know, there was nowhere you could go. You could hang out in Hollywood Boulevard and hope somebody would walk by, but they usually didn't. But if you came to Del Mar, guess what? You saw Ava Gardner. You saw Randolph Scott. You saw, you know, all the great, really stars of that golden age of Hollywood, and they were right there. You could see them. You could almost touch them. You could shake their hands even. Red Skelton, I remember. You know, they asked him how his betting was coming. He took off his jacket, and he had purposely had no shirt. He just had a collar and a bib. So he I lost my shirt. You know, I mean, anything for a laugh. Anyhow, yeah, out of Hollywood we came, and I guess out of Hollywood I came. So it was a good match. But I will tell you that that I am so delighted that you're here, and especially this time. I mean, I spoke briefly at the first one of the owners' conferences in Kentucky and Lexington at Keeneland, which is Keeneland and Del Mar have very similar managements. You know, we just think alike a lot, and not a lot of egos, but just kind of hopefully some smarts as to what the public wants to see and how we should present our product. So, you know, we've been thinking about Breeders' Cup here at Del Mar since 1984, the first one. That time we had our old grandstand, which was falling apart. So I figured, well, you know, maybe a new grandstand, maybe a new racetrack, maybe, you know. Well, we managed to accomplish that. Since then, we've spent probably a couple $100 million building the place up with new racetracks, whole new grandstand. And always at the back of my mind was the Breeders' Cup, and here we are. And I can't tell you how proud, thanks. But it's terrific for us because, you know, it was fun when we went to New York to the Breeders' Cup board to make our pitch. They were the top 5 guys, you know, marketing and accounting and operations and stuff and racing. And I looked at the audience, I went, there's a whole lot of people out there that have never been to Del Mar that are making a decision whether or not to come to Del Mar. So I kind of switched my tact a little bit and started talking about Del Mar, the market area, San Diego, the market area. And that's what makes really our life a lot easier as far as marketing our product or ourselves here. San Diego is a great market, but it's small enough to where they notice you. So in the summer, opening day at Del Mar is the major news story in all the papers, all the TV. They cover it. There's 5 or 6 news crews out from every channel for society stuff and for sports, for general news. So it's really kind of cool. And they're big enough, though, to support us. And we get terrific crowds. We have a lot of things going on at Del Mar. We have concerts and family fun days. And we got rid of the Cougar Day contest, though, but... well, my wife got rid of the Cougar Day, to be perfectly honest with you. Yeah. We named a race the Cougar, but it was after the horse Cougar. And one of our young marketing guys came, "That's so cool, Mr. Harper, you got a race named after cougars." I said, "No, it's a horse." "Oh." He said, "Well, why don't we have a cougar contest?" I said, "Why don't you call Mrs. Harper and see what she thinks about the cougar contest?" So I guess she wasn't at home, so we decided to go ahead and do it. You know, it was hardest. Who wants to admit they're a cougar? You know? So this marketing guy was tall, good-looking guy. That's how you get cougars. You send him into a cougar bar, you know? And he comes out with a bunch of cougars, and we sign him up for the contest. That lasted for about 3 years. Got a lot of publicity out of it, but it was pretty shameless. But anything for, you know, audience. I don't know where I was going with that, but anyways, it's delighted having you here, and I hope I can't tell you how delighted it that the Thoroughbred Owners Conference is here, and I think hopefully you'll enjoy Del Mar and the regions. There's all kinds of good hotels, including this one. I just spent 200 days in this hotel last year remodeling a house, so I like this hotel. Yeah. Anybody ever try to spend 200 days in a hotel room with their wife? The only thing that saved the marriage was they had an empty suite, so I was sent to the living room and the marriage is still in good shape, but it was tough. Anyway, have fun. That's the most important part. And I think you got some great speakers, and I'm so delighted that you're all here. And on behalf of the Thoroughbred Club at Del Mar, welcome to Del Mar, and have a great time. Thanks. Thanks, Tom.
Thank you, Joe. All the best.
You're the best.
You know, all over town you see these clocks that are counting down, to the Breeders' Cup. They've got one in the hotel here. Joe, did you have a clock counting down from 200 days in your hotel room?
I should have.
But, that clock probably started sometime in 1984 when the first Breeders' Cup was held up at Hollywood Park. And now finally a dream has come true, and it has been too long in coming. So just a couple days more of waiting before the turf meets the surf with the Breeders' Cup. Thanks, Joe, for that. And now the best advice I have for you all coming here to the event is to mix it up. Get contact with all sorts of people that have come from all over racingdom to be here. Just ask questions. Everybody here has one thing in common. We all love horse racing. And this is a great opportunity just to ask away and network, as the way say these days. A few things to remember. First of all, when you checked in, you should have gotten your lanyard with your credentials. There's a lot of stuff on there, so please make sure you do wear it throughout the convention. It's the right thing to do. And this is your conference magazine. There's all sorts of good stuff in there, including a very flattering picture of myself. And it's got your daily agenda in here and a lot of really good reading. So please do that. And if you want to connect to the internet, here are your instructions on the screens behind me. So please get connected. In addition, when you walked through the foyer today, or if you're an aristocrat, it's pronounced foyer, to get into the room here, there's a new addition to the conference called the Exhibit Area. Exhibitors from all walks of the industry are here to help you become more familiar and answer any questions you have about anything concerning the great game of horse racing. So be sure to check that out during our various breaks. And if you get thirsty or need a little nosh, right here in the back of this room, just feel free to go up anytime, have a beverage on courtesy of the National HBPA. And any questions of any kind, just please see our staff. They are dressed in black and white, and they are ready to help you for any questions you have whatsoever. And they'll be directing you to various spots throughout the next 3 days. And of course, we'd like to thank our conference hosts, Owner View, and the Blood Horse. And every conference needs sponsors, and this presentation is being sponsored by Gainesway Farm, 1,500 prime acres of some of the most productive land in thoroughbred history. Gainesway Farm is home to a roster of stallions that have left their mark on the breed, including a Fleet Alex, Birdsong, Empire Maker, and the world's leading sire, Tappet. Gainesway Farm, power, passion, and performance. So now our first panel, and this is how you get started if you've never owned a horse before. You go to the corner of a bar, and you're just sitting around there, and someone says, "Let's buy a racehorse." And then somebody else says, "That's a great idea. Yeah, let's buy a racehorse." And so you say, "Good, here's a check. go hire a trainer, go hire a jockey, buy a horse, and then call me the morning he's going to get ready to run. That's how it works. Not really. Not the best way to go about it. You really need to plan. You need help. You need advice. You need a financial plan. You need advice about any particular matters, tax and accounting practices and insurance and liability. So you need advice from people with the expertise. And guess what? They're here. About you to introduce you to Jen Shaw from Dean Dorton Ford Allen. I just love saying that. This got such a stentorian tone. Dean Dorton Ford Allen. And from the equally superlatively named firm of Stoll, Keenan, and Ogden is Shannon Arvin. And I just love saying those names. And by the way, I do know that when I'm up for my next felony charge, I want your firms to represent me. Thank you very much. Jen and Shannon.
Well, thank you, Tom, and I'll make sure that if you have a felony charge, I'll give you Shannon's number right away. Well, good afternoon, and Shannon and I are delighted to be here to talk to you all today about maybe some of the more mundane, but in our opinion, more important aspects of horse ownership. And we're often called, as Tom mentioned, to help people establish their horse racing ventures or horse breeding ventures, talk through the legal and tax implications. And so with that, we have provided everyone a handout today. And if you're sitting on the sides, you don't have a handout in front of you, make sure, don't be shy, come up and get one in some of the rows that have the handouts. But this is...
They're all in the middle.
Yeah, all of the middle two rows have the handouts. But this is really a tool. Don't worry, we're not going to go through 16 pages of tax and legal this morning or this afternoon as much as we would like to do so. But basically, we've arranged some discussion points for the first part of our presentation, and then we'll allow plenty of time for Q&A at the end. And we're going to talk a little bit, at least in the beginning, about direct horse ownership. So those of you that invest directly in horses, we're going to get into the details of that, both entity selections, operational items, and then we're going to talk a little bit about tax incentives as it relates to depreciation. We'll then move into those of you that invest via partnership or co-ownership and talk about some of the tax and legal implications of investing that way. And then we'll wrap up with some tax-specific items dealing with hobby and passive, and then talk a little bit about best practices that we've learned and that our clients have learned over the years as you're investing in horses. So with that, I'll turn it over to Shannon.
And if you're still here after that introduction, we're delighted. I think you'll hear an overarching theme through our conversation. This is a great business. It's a great, exciting sport. We are all united in a love of the thoroughbred and the game. But it's most fun if you surround yourself by the right people and good advisors and make sure that you know what you're doing. And if you have a question, you won't be the first person to have that question, and be sure that you ask the question. It's important to educate yourself, because that's what's going to make this whole ownership process fun. So first thing, as Jen said, if you decide you want to own horses, you are an individual. How should you own your horses? So you've got a couple options. You can have a sole proprietorship, which is a fancy way of saying you're going to own the horse in your individual name. There's some liability considerations that we'll talk through about whether or not that's a good idea. Other options would be a general partnership, a limited partnership, a corporation. You all probably all know sometimes corporation inherently means a double taxation level. That's not optimal unless you're a foreign owner. Talk a little bit about that. But what I most often recommend at the end of the day, once I'm talking to a client, is that they own their equine interest in a limited liability company. LLCs are easy to set up. You could set one up even without a lawyer. You just file a certificate of formation with the Secretary of State and the state where the entity is being formed. Jen will talk a little bit about the tax or non-tax implications of that. But that gives you the right structure to start. And then from there, that LLC can own multiple investments, whether it's an interest in a thoroughbred or an entirety of a thoroughbred. It's a good place to start. Accounting methods.
So let me just talk a little bit, just real briefly. Shannon covered the legal aspects, and we're doing this very high level, just in an interest to get through and give you some high level information. But from a tax perspective, much like Shannon, we primarily see people utilize flow-through entity structures, so LLCs, some type of partnership. Typically, we only see people utilize C Corps as it relates to if you've got a non-US person owning horses in the US. Alternatively, S corporations are beneficial for those that provide services, trainers, bloodstock agents that produce commission income. It reduces your exposure to employment taxes. So, but again, primarily the structures that we see are those like an LLC or a flow-through entity. And that can be a single member LLC too, which is just reported directly on your individual tax return. For most in the horse business, there is a beneficial accounting method available, and that's the cash method of accounting. And why that's beneficial is it allows me as a horse owner the ability to deduct expenses up front. So for instance, if I pay a stud fee in 2017 for a 2018 breeding right, that foal will not be born until 2019 and won't have the ability to produce any type of income until late 2019 if sold as a weanling, 2020 if sold as a yearling, or as a racehorse thereafter. So I've been able to deduct that stud fee up front, and so I'm able to front load my deductions. So oftentimes in the horse business, it's difficult to show a tax profit in the beginning of your venture, primarily because we've got this cash method of accounting that you can utilize. The caveat to that is that if I am a partnership and I allocate at least 35% of my losses to passive investors, I have to use the accrual method of accounting, which is a little bit different. That sort of matches up my income and expenses in the same year. So again, for the majority of people, you're able to utilize the cash method, which is positive.
So it's time to buy a horse. How do you do it? People in the horse business hate documentation. They hate agreements. They like to do things on a handshake. I've been practicing now 15 years, and probably in 8 out of 10 scenarios, maybe even 9 out of 10, that works just fine. But it is easy to have pretty simple documentation that doesn't cost a whole lot of money that puts you on much stronger footing. So if you're buying a horse, some states, Kentucky included, require you to have a written bill of sale if the horse is going to be more than $10,000. A bill of sale, I've seen them be 1 page. So lawyers don't, equine lawyers understand the way people feel about contracts, and we really try to distill it down to what's really absolutely necessary. So you do have to have that in writing. You have to be sure that you're getting good title to the horse. Just like if you were going to buy real estate, you wouldn't buy real estate without having a title exam done first. If you're dealing with a private sale, you ought to have somebody do a UCC search, Uniform Commercial Code search, of the seller to be sure that there aren't any liens against the horse, because to the extent there are, they could continue on to the ownership interest in the horse, and you'd be stuck dealing with the seller's creditors. Warranties, it is very customary in the horse business that a horse is sold as is, where is, all warranties being disclaimed. So what does that mean? You got to be sure that you've looked at the horse before you agree to buy the horse, and that you're comfortable with the condition of the horse. Vet exams are very customary when you're buying a horse. In terms of the bill of sale, it can either provide that, sometimes you'll sign the agreement right away because you want to get the horse under contract basically, and say that the sale is subject to satisfactory vet exam as determined in the reasonable discretion of the buyer. And that's a fine way to do it. Other times people have already done the vet exam and they just want to sign the bill of sale, and then the deal is done, which can be simpler, more straightforward. Risk of loss is really important when you're dealing with a bill of sale. If you sign an agreement that says risk of loss passes at the time both parties have executed that bill of sale, if something happens before you go pick up that horse, but you've both signed the bill of sale, you're paying the purchase price, whether or not you are happy with the condition of the horse and whether or not the horse suffers an injury on your way to go pick him up. So be cautious about that. We'll talk about insurance in a little bit, which can help you on that front. Commissions, you'll have probably heard a lot about commissions. Your bill of sale ought to say whether an agent is being paid a commission, period. There are some states where If there's a dual agent, meaning the agent's being paid from both parties, representing both parties, it's required by law to be disclosed. And if it's not, then the agent has to pay treble damages, triple the amount that he was to receive under the agreement, and attorney's fees. So I always err on the side of just disclosing the commission. There's nothing wrong with paying agents. You ought to pay agents. They've been working hard to get the deal done. But it ought to be disclosed. There's no reason for it not to be set out clearly in the agreement. The bill of sale will also deal with the Jockey Club certificate of registration. You all may have already seen that. Right now it's in paper form, and it has all the pedigree on the front page, and then on the back page it's a ledger. It kind of looks like a checkbook ledger. And you just want to be sure that the bill of sale provides that you'll receive those papers as part of the sale. Those papers will be required if you want to go sell the horse in a public auction down the road. Those papers will be required if you're racing the horse, because they'll need to be with the trainer and on file with the racetrack. So the Jockey Club certificate of registration is important. So if you decide instead of going to buy a horse through a private sale, you want to go to the public auction, the documentation that governs that sale is in the conditions of sale. It started as a really, at least at Keeneland, I can tell you, it started as a really, really small document with a couple pages. And as we've gone along, it's grown as the sales company has responded to market conditions. So now you start with an as-is, whereas, disclaimer of all warranties, but there are certain warranties, limited warranties, that you do have when you buy a horse at public auction. For example, if the horse is a cribber and you notify the sales company within a certain window of time, you can return the horse. But the conditions of sale are what governs that transaction. If you're looking for some light reading to put you to sleep, that's where you will find it. But they are really important. There is a repository at the sales company where x-rays are available. If you're buying a horse at public auction, get a vet that you trust to go look at those x-rays. Be sure you're comfortable and know what you're buying. Be sure that you've looked at everything. The conditions of sale are very clear that you're charged with that information. They encourage every buyer to go look at a horse before they buy them. Liens, interestingly, are not an issue at public auction. Most state laws provide that the buyer of a horse at public auction receives the horse free and clear of any liens. Because if we had a situation where a buyer had to go try to do lien searches on 4,000 horses going through a sale, it wouldn't work very well. So as a buyer, you don't have to worry about liens at public auction. The liens do continue in the proceeds from the sale, but that's up to the seller and the sales company and the claimants to deal with. Risk of loss at public auction passes at the fall of the hammer. So you may have heard of fall of hammer insurance. We'll talk about that a little bit too. But as soon as that hammer goes down, if you're the buyer, you've got the risk of loss on that horse. Here's where I come back to my theme. If you are new to the business and you're going to a public auction for the first time, I think they're tremendously fun to watch. It's fascinating to me to watch the volume of horses that go through the sales ring. In 2016 at Keeneland, there were 6,400 horses sold, $523 million in horses. 2017 sale, the sales exceeded in gross sales $300 million for the first time since 2008. There were over 4,000 horses cataloged. They are fun, but they are really intimidating. And I've been around the business and around Keeneland my whole life. I would never go buy a horse without somebody that I trusted that's experienced in dealing with the bidding process. And likewise, if you are bidding on your own and somebody comes and asks you to sign the purchase agreement and they recognize you as the bidder, if you don't think you're the bidder, or if it's not the price that you understood that you'd paid, don't sign it. It's okay. I mean, sometimes when you've got that volume of horses going through, it's really important that you don't get intimidated into signing something that you didn't intend to do. Sales tax, just to mention, and this is Jen's bailiwick more than mine, but we do deal with this. There is sales tax generally in Kentucky it's 6%, in California it's higher, it's 7.25%, plus some local sales taxes can apply too. There's some exemptions, but just be aware that when you're trying to decide what price you're willing to pay for a horse, you might have to factor in a sales tax there. And generally the seller remits the sales tax to the state, but the buyer's responsible for paying it.
And just one thing, in your handouts, we have actually included a link to, our firm does an equine sales and use tax multi-state guide, and so there's a QR code in there. If you click on that, it'll link you to our e-version of our equine specific sales and use tax. So it goes through, we have 20 states in there right now, and we add about two to four every year.
Insurance, which I keep alluding to. Insurance is really important in this game. It is important to have somebody good to ask questions to about the insurance, a good agent. You'll find a lot of different insurance agents in the equine field. There are really three main types to be cognizant of: mortality, fertility, and general liability. So starting with general liability, there's a policy for horse owner liability coverage. You might think, well, it's covered under my homeowner's policy. You might think, well, it's covered under my umbrella. It might be. It's worth looking at that. But often anything that's done in a commercial pursuit can be excluded, particularly from the homeowner's policy. It's $95 generally, the premium is, for a year for $1 million of coverage. So it's a good basic insurance coverage to be sure that you have. Mortality, generally referred to as all risks mortality. That requires a full vet exam of the horse, unless it's the fall of hammer insurance, which I mentioned. So your insurance agent can give you fall of hammer coverage. So when the risk of loss passes to you, you have coverage. It's generally limited just to something catastrophic. So if something happens to the horse in transportation, or there's fire or lightning or something along those lines, you'd be covered. But it's limited to those things until the underwriter has had a chance to do a full vet exam. The cost of that mortality insurance varies, generally anywhere between 4% and 7% of the agreed value of the horse. It also varies based on the kind of horse and on the owner. That's another factor that plays into the pricing that the underwriter does. Fillies rates are usually lower than colts. And then finally, stallion insurance. If you are investing in syndicated stallions, or any stallion, but getting into it, I would recommend starting with a syndicated stallion and buying a fractional interest instead of the whole stallion. There's first season infertility, also referred to as congenital infertility. Basically, that coverage guarantees that the stallion will get a certain percentage of mares in full the first year. It's usually 60%. And if they don't, then the policy pays. There's also AS&D, accident, sickness, and disease coverage with respect to stallions, which is just what it says. If the horse is sick, or there's an accident, or he gets a disease that impacts his fertility, that coverage will pay. Usually they price those stallion first year fertility coverages as a package. So you can figure generally 8% of the value. So 3% mortality, 0.5% for AS&D, and 4.5% for the FSI. You will see, and as if you do get into the stallion game, syndicate agreements are shorter than the conditions of sale, but they're pretty long and involved, and it is good and important to read them. I will tell you, with respect to insurance coverage, it's always going to say that the syndicate manager has the authority to deal with a horse the way that the syndicate manager deems best. So often you'll have a stallion farm that says, look, we're only going to have one stallion fertility policy, because the syndicate manager doesn't want to be in a situation where you, as an owner of an interest in the stallion, is saying, well, my insurance company is saying you need to go to try this because this might help the stallion's fertility rate rise. And the syndicate manager policy is saying, no, you need to do this. So the agreement will always say that the syndicate manager has that authority. Licensing. How many people are licensed? A lot of you. Okay. So you've been through that process. Licensing used to be a lot harder than it is now. Licensing used to be a process of scampering around on Saturday morning trying to find somebody that could do fingerprints to be sure that you could get licensed in a given state. Now we have the National Racing Compact, and they make it really easy. They make it a lot easier for me, too. You get fingerprinted through them, you pay a fee to be licensed through them, and then all you do is, I call my buddy Pat Thompson at the National Racing Compact, and I say, hey, these people are gonna be in California, please make sure that they have what they need. So that has gotten a lot easier. But don't overlook it. It's important to be licensed. And even if you're investing in syndicates and co-ownerships, there are some states that have a de minimis exemption from being licensed, but my advice is just get licensed and take that off the table as an issue, because the state would have the authority to disgorge the purse if you're not properly licensed, and it would cause some problems. So if you're in the racing game, it's a good idea just to be licensed through the National Racing Compact.
And oftentimes I'm asked, what are estimated costs? Estimated, and it's hard in the horse business to certainly estimate your total cost, because each horse varies substantially, but I have in the handout included a couple of different estimated costs for various owners. And so for instance, if you're a mare owner and you're paying a stud fees in the US are as high as $300,000 right now. So you would factor that in. If you're a breeder, your estimated direct costs for basically producing a foal and to sell that foal, whether it be a weanling or whether it be sold as a yearling, not including stud fee, but including direct expenses like board, use of the mare, vet, those run about $25,000 to $45,000 depending on when you sell that foal. Again, the sooner you sell that foal, the less maintenance costs you incur. And then from an annual direct expenses as it relates to racehorses, typically we see between $40,000 and $50,000. Again, not including some of your overhead costs, and that would vary depending on where your racehorse is, what type of trainer you utilize, and that type of thing. So it varies widely within the business, but I think it's important to understand and to look at maybe how others are doing it, or some metrics that are available. And there's really no necessarily public guidance on it, other than some analytics that are published in the Blood Horse or other items. But based on what we see with our clients around the country, that's the general areas that we see. So Shannon talked quite a bit about operational matters. I'm going to talk a little bit about depreciation incentives, because that's really always a hot topic. And again, depreciation is a timing issue. It's when can I deduct the cost of the horse that I purchased? And for horses that are 2 years and older and breeding stock that is over 12 years old, it's a 3-year recovery period. For yearlings and for breeding stock 12 years old or less, it's a 7-year recovery period. And we say 3 and 7 because that's just that's the terms, but really it's 4 and 8 because you get half your depreciation in the first year and the last year. So essentially, if you buy a yearling racehorse and place that yearling racehorse in service, you, under current law, you would depreciate that racehorse over an 8-year period. That differs from 2016 and prior for several years, where we've had a 3-year recovery period for yearlings. So there's still proposed legislation out there. Again, anything in your handout is based on current tax law as of right now. If we have tax reform come in, there's some items within tax reform, such as fully expensing your purchases that are on the table, but again, that's proposed at this point and not yet tax law. So whatever's in your handout is based on current tax law. I've also included some examples as it relates to when you can recover, how the depreciation is calculated, that I don't think we need to go into today. But there's some examples in your handout about when you would recover that purchase price. If I spent $100,000 for a yearling, how that would look if I took the 50% bonus depreciation, which we'll talk about in a minute, and or if I elected out of it. So again, it's a timing issue because it's really just when do I get to deduct my purchase price. So one of the items that's currently available to horse owners is something called bonus depreciation. And right now you can deduct 50% of the purchase price of the horse plus the remaining normal depreciation on the remaining 50% of the horse that was purchased. So for horses placed in service in their 2-year-old year that have a 3-year recovery period, you end up being able to deduct 62.5% of the purchase price in year 1. For a 7-year property, it's about 54%. So it's a positive benefit that is available to items that are qualifying, and the qualifying items must be new. So it can't be a horse that's been previously used. It cannot be equipment that's used. It has to be the first use of the horse. And so typically most breeding stock would not qualify because in order to qualify, breeding stock cannot have either been raced nor bred. And most breeding stock that goes to the sales, even if it's unbred, has been raced in the past. I've not yet found, we might have found one mare that may qualify in all the mares that we've looked at. But typically, breeding stock will not qualify. Yearlings or 2-year-olds, depending on what your policy is, may qualify. And typically for racehorses, you place a horse in service either the fall of their yearling year when they begin training or their 2-year-old year when they begin racing. And when we talk about depreciation for 2-year-olds, it's not January 1. Most horses, every horse turns 2 or is 1 year older on January 1 for operational items. For depreciation, it's the 2-year anniversary of their foaling date. So it's a little bit different. So again, bonus depreciation would be available to those new items, and it would be for things like barns, land improvements, farm equipment, certain qualifying horses, office equipment. So it covers a wide variety of different items. And also the bonus depreciation can be used to create a net loss. So that's something that if you even have already have a loss and if you want to accelerate deductions and offset other income, you can utilize the bonus depreciation to increase your loss. The second tax incentive as it relates to depreciation is what's called Section 179 deduction. And that for 2017 is $510,000 deduction on up to $2,030,000 of purchases. Section 179 cannot be used to create a loss. So if I'm in a net loss position already, I can't utilize Section 179. If I do have income, this is a great way to reduce the amount of income. And essentially, Section 179 deduction, this $510,000 that's out there, is available for most tangible property. So it wouldn't be available on things like barns or land improvements. It would be available on horses, and it doesn't have to be new. So you could use this, we typically see this used on breeding stock. It could be used on any type of horse. Also farm equipment, farm fencing. That's really what 179 covers. Most states, however, just a little caution, most states do not recognize the increased Section 179 deduction, so this $510,000. Some states, like Kentucky, like California, still have a $25,000 limit. So you may qualify for this for federal, but it may not be a current state tax deduction. So just something to be to make you aware. And if you own horses in a partnership, the partnership calculates this first, and then you include it on your individual return. So it's really, you look at the limit 2 times. If you own horses directly and they're reported directly on your individual return, you may be able to show a net loss from your horse operations, but have other business income to offset it. So I just mentioned that because that happens from time to time, and we see that occur, and people sometimes miss that. So that's, as it relates to the 2 primary depreciation incentives that are available for horses right now, the bonus and then the 179 are what we primarily see. So let's switch gears. We talked a little bit in depth about direct horse ownership, and Shannon's talked the operational side and gotten into a bit more depth. Let's talk a little bit about high-level partnership and co-ownership considerations.
So everybody's heard probably the term syndicate thrown around. I'd say racing syndicates definitely in the past 5 years have made a huge comeback, which is great. It's fun. You see Little Red Feather and West Point, some others represented here. It's really a fun way to get into the game. But it's really important to know how you're getting in and what you're getting for what you're investing. There are some syndicates out there that don't have an investment component, that really they're just selling the experience and the ability to attend the races and be involved in the ownership. There are others that are actually an investment where you might hope to hit it big and make money. Whether you're investing with a racing syndicate, a breeding syndicate, or whether there are 2 friends that have gotten together and decided that they want to buy a horse together, while it's not legally required, put it in writing. Even if it's a letter between you all, even if it's a term sheet, if there are 2 of you, just think through what some of the things are that are going to come up that could cause a fracture between you if you're 2 owners. That can be a co-ownership agreement, that can be a limited liability company operating agreement, that can be a partnership agreement. It can take it can be a lot of different names, but it ought to spell out who's making the decisions, who's going to decide when the horse retires. That's something you see a lot of now. It's great. People want to continue to raise their colts instead of take them right back to the breeding shed. It's fun as a fan to see that. But there's a real financial component there. And if you own an interest in a horse, you ought to understand what's going to control when that horse retires and the terms that are going to govern when the horse retires. Where's he going to go to stud? And same thing for a filly. If you've got a filly that's going to go back to the breeding shed, when is it time to stop her from racing? Who decides which trainer to use? Who communicates with the trainer? Some trainers are happy to speak to 50 owners in a day. Some trainers are not going to want to speak to more than 2 in a day. So understand who you're dealing with and who's controlling that. Who gets paddock passes? You know, some of these larger syndicates, that can be a real issue because you've invested this money, you want to go see your horse in the paddock. That's part of the reason that you've decided to make this investment. So understand if that's part of the deal or not. Some syndicates I've seen do a lottery on who gets the paddock passes, but the tracks sometimes don't physically have enough space for all of the owners and their connections. And whose silks will the horses run? That's also a big deal for people, particularly when you've got fewer owners. And I've seen that go a couple ways. You know, sometimes people agree they'll alternate, but it just ought to be spelled out. Who gets to keep the trophies? It's funny because when we get to this, I have a lot of clients say, well, we'll just get a duplicate. Well, a duplicate of the Kentucky Derby trophy, I'm going to tell you, is pretty expensive. So if you say that
Which would be a great problem to have.
Yeah, it would, least of your problems. But if you get to that point, at least provide whether you're happy to have the whole ownership split the cost of a duplicate, if it's even feasible to obtain a duplicate, or if you're going to alternate between races and it's luck of the draw as to who might get the big graded stakes trophy. So I think all of those things are just really important in terms of being sure you understand what you're getting and you understand what your plan is. Whatever investment you're making, understand what you're getting for it so that you have realistic expectations. The other thing I'll just mention briefly and won't dwell on it, but securities considerations are a factor when you're investing in racing syndicates and breeding syndicates. Just be sure that you're not buying an unregistered security that doesn't have an exemption. Basically, a security is an investment with an expectation of profit solely due to the efforts of a third-party promoter. It's just a good idea to have an advisor review the documents to be sure that you don't find yourself in a spot where you don't want to be on that front.
And from a tax perspective, if I'm investing in a co-ownership or I'm investing as a minority member of an LLC, obviously it's a great way to get into the horse business. You've got, it's a little bit less cash outlay because you're splitting those costs, those maintenance costs of those horses. And so there are a lot of reasons certainly why you would do a co-ownership or a partnership versus investing directly. But with that comes a little bit less control. So essentially, as Shannon was talking about, really looking at the documents, what are you signing? The partnership makes the decisions. So you as a minority owner are not in control, and you have to give up some of that in exchange for maybe less out-of-pocket expenses. So just be aware that that's something that it's a pro and con, and just determine one of the factors you should look at when you're looking at whether or not to invest directly versus invest with others. And from a tax reporting perspective, as a member in a partnership, you receive a K-1. So you're not putting it on directly on your return on a schedule. You do put it on your return, but you'll get a Schedule K-1 that summarizes the activity. So it may be that the partnership certainly files a tax return and reports all of the detailed activity, but you may get a Schedule K-1 reporting statement that just shows one number on it. And that's your net portion of the net operations for the racing syndicate or partnership. There's also another type of entity that's quite common in the business, and it's not even an entity, it's just a co-ownership. And so where I own 50% of a horse and Shannon owns 50% of the horse, and we don't do a partnership agreement, and we meet the criteria to be co-owners in the horse, then typically we wouldn't the partnership, there's no partnership, so there wouldn't be a tax return filed, and we would each just report 50% of that horse's activity. And the benefit of doing a co-ownership is that if I want to depreciate the horse differently than Shannon wants to depreciate the horse, we can do that. The downside is that several co-ownerships in the industry may technically be partnerships under federal tax law, but again, industry practice for a lot is that a co-ownership can exist, and you have a little bit more flexibility there. So again, that's just a mention about what it means from an income tax perspective, from a legal perspective, as a co-owner or a minority member in an LLC. So we've talked a bit about the co-owner route or the partnership route. Let's talk a little bit about some income-specific tax considerations as it relates to hobby and passive. And essentially, one of the first questions I get when someone makes that the call from the bar about how they invested with their friend in a horse, or they buy a horse at Keeneland or at Fasig, is, okay, great, I've bought this horse. What does that mean? What can I deduct? What kind of expenses? What does this mean from an income tax perspective? And because of the incentives available for income tax purposes, again, we can front load our deductions. So oftentimes, your first few years, you certainly have deductions in excess of income, and maybe for several years after that too, depending on how your operations go. So the IRS has a few hurdles to currently deduct those losses. And those would be, the three main ones are hobby, passive, and then at risk. And we're not going to talk about at risk today. We're going to talk about hobby and passive, because that's really where the bulk of our time is spent when we're looking at this. And hobby, for income tax purposes, is a dirty word. Essentially, it's a heads I win, tails you lose scenario for the government. If I have a horse venture and it's deemed to be a hobby, I have to include 100% of the income generated on my income tax return, and I can only deduct those expenses up to the amount of income generated. They're treated as what's called a miscellaneous itemized deduction. And so for those of you that are in alternative minimum tax, which most everyone, there's quite a bit, although in Trump's tax reform, they're talking about eliminating that. But as of right now, under current law, if I am an AMT, those get added back, and I lose that deduction 100%. So essentially, I pick up 100% of the income and get no benefit for the expenses. So that's why it's so detrimental to be in a hobby position. If I am deemed to be a hobby, I lose those deductions. There's no timing differences. I'm done. I pick up 100% of the income and then move on. So again, this is why there's so much focus. If you are going to run your horse venture as a business, it's important to know how to run it like a business so that you can avoid being classified as a hobby. And the IRS has issued regulations that list 9 factors that they test. And really, when I do audits around the country, this is where we spend the bulk of our time, and we go through the 9 factors. I've listed them in the handout, and we're not going to talk about really specifics, but it's really operating in a business-like manner, how much time and effort you spend on the activity, your expectation that assets appreciate in value, your success in similar or dissimilar business activities. Have you shown that that you can take a business from startup to success? The financial status, elements of recreation, which obviously financial status and elements of recreation. Some of those those two especially are a little bit err on this. They favor the IRS in those situations, because you have to have a good amount of finances to be in the horse business, and there's and of course you're going to enjoy seeing your horse running around that final turn being in first place. So we found that none of these factors are the single determination for whether you're hobby versus business. They all are considered, but there's some that are more important than others, and that's really running your horse venture in a business-like manner. So maintaining separate books and records, keeping all your personal and hobby items outside. And oftentimes we find that the IRS is unfamiliar with the horse business. So again, I had an agent in Texas think that a large thoroughbred breeding operation on the East Coast was a dude ranch. And in Connecticut, this farm was equated to being kind of like a pony farm that, the agent's daughter, rode ponies. And in Ohio, I had an agent tell me that, well, isn't every horse eligible for the Kentucky Derby? So, which we all wish, right? So there's just, we do find that going around the country, we do have to educate the agents. There's a safe harbor provision that some people over-rely on, but it is important to know. And if for most businesses, if I make a tax profit in 3 out of 5 years, then I am deemed to be in the business versus hobby. So what that means is that the IRS has the burden of proof to prove that I am a hobby versus a business. For horse operations, instead of 3 out of 5, it's actually 2 out of 7. So if I generate a tax profit in 2 out of 7 years, and the IRS comes in and audits me, the IRS has the burden of proving that I am a hobby versus a business. On the other side, if I haven't shown a tax profit in 2 out of 7 years, then I have the burden of proving that I am a business versus a hobby. So it really just shifts the burden of proof. We do work with clients sometimes. It's important to them to get that 2 out of 7 years to try to either accelerate depreciation deductions in loss years or move depreciation deductions around where we can if that 2 out of 7 years is important. I will say that we work with clients that have never shown a tax profit, but you can show, even if you can't show a tax profit, perhaps you can show what's called an economic profit. So if I have if I haven't really sold bloodstock yet, and I've got that unrealized appreciation in that bloodstock, because again, I've deducted that stud fee up front, and I've got this foal sitting there with a 0 tax basis, if there's significant appreciation in my bloodstock, I can show maybe that I have an economic profit. Or if I use my farm directly with my thoroughbred operations or my sport horse operations, and there's a significant increase in the value of that land, that would also qualify for economic profit. And again, that has to be specifically tied to your horse operations, if the appreciation in land. So again, there's ways to, if you haven't generated a tax profit in 2 out of 7 years, you're not automatically deemed a hobby. You're just going to have to go through the 9 factors and prove to the IRS that you're not. So again, really with the horse business, there's so much availability of deductions up front that typically it is a challenge to show a tax profit in 2 out of 7 years, especially at the startup years. So again, we do talk to the IRS quite a bit about hobby, which again is detrimental because you lose the ability to ever deduct those expenses in excess of income. So if your horse venture is deemed to be a business, then you have to look at what's called the passive activity rules. And the passive activity rules, there are 7 tests that the IRS has issued to determine if you're an active versus passive participant in the horse business. And I've listed those in your handout. But the most common by far in the horse industry is the 500-hour rule. And that's where if I have spent at least 500 hours, and we'll talk about what qualifies for time, in a calendar year for that business venture, then I am deemed to be an active participant versus passive. And this here is just a timing issue, much like depreciation. So if I'm deemed to be a passive investor, I can only deduct my passive losses if I have other passive income to offset it. Or when I liquidate that entity or that venture, I can claim any suspended passive losses at that time. So again, I don't lose the ability to deduct my expenses, it's just a timing issue. If I have other passive income, so if I'm generating rental income and I've got these passive losses, I can offset the two. So it's really a non-issue. But we do get into quite a bit of discussion about what qualifies from an hours perspective. And so I have listed time in your handout of what should qualify, but it's items like directly taking care of the horses, that obviously qualifies. Attending races and sales, the prep time to when you're preparing for the sales and you're meeting with your advisors and you're determining which horses you're interested in and you're visiting the farms and looking at the horses that you may purchase, that all should qualify. Your professional reading, attending seminars like this, that should qualify as well. You're looking at pedigree research, just reviewing the plethora of data that's out there and analytics that you utilize in your horse operations, that time should all qualify. And also your travel time to qualifying activities, like when you go to the sales or when you go to the races and your horse is racing. Those all should qualify. Now, what I will say is that oftentimes the IRS will come in and take a look and want to not allow all of that time. And so what I recommend is that you don't show 504 hours only in a particular year. You might show 750 or something significantly above 500 so that if they start nitpicking, it's less of a fight. And one other caveat is that if you participate in the horse business and your spouse does as well, your activities are combined. So if me and my husband own a horse and we're in the business, just the two of us have to reach 500 hours combined in total, not 500 hours separately. So again, that can be a positive way to get your 500 hours as well. The other thing I'll mention is that there's no requirement to maintain contemporaneous records as it relates to tracking your time, but please do so. You can be audited 3 years after you file your returns. That's 4 years after a calendar year, and it's hard for me to remember what happened 2 months ago, much less 4 years ago. So we've had to help people recreate calendars based on the cyclical nature of the business, and that's worked okay, but it's expensive and it can be very tedious. So we recommend people keep logs to track their time. The other thing I'll mention is that if you invest in horses through multiple vehicles, maybe you have some direct horse activity and then you also are a member in partnerships or syndicates, there's an opportunity to do what's called a grouping election with your personal return. And what that does is you can elect to list the entities that you're doing the same or similar activities in, and that way you only have to reach 500 hours versus 500 hours in each separate activity. So that's available too from a personal perspective. So we thought we'd wrap up here with our prepared comments, and then we'll open it up for Q&A with just some best practices or things that, questions that we're asked from time to time. And I know one of the questions I'm asked all the time is this profitable? Can I make money? And first, I think it's been a theme that Shannon's mentioned it, I've mentioned it, but this is a risky business. So you need to go in with eyes wide open and understand that worst case scenario, you could lose everything that you put into it. But with that being said, there are times, and we do have clients that show tax profits and make money in the business. And they do it through either on the racehorse side, they've got a successful racehorse, and so it's the purse winnings, the significant purse winnings, and then eventual sale of that horse. On the pin hooking or those that are reselling, that's typically a short-term holding period, and it's a quick turnaround. So you might do a weanling to yearling, a yearling to 2-year-old, a mare and foal to mare and foal. So it's a quick turnaround, and it can be a way to make money. On the breeding side, you could have a sale of a successful mare, her sale of her progeny, and obviously stallion shares and season income. So there's certainly ways to make money too. And I often recommend that people diversify if possible, not just do all racing or all all breeding, but probably all breeding is less risky than all racing for sure. So if you're going to do racing, it might be good to consider some breeding activity as well, because again, the racing is a bit more risky.
And I think it's good to just set your parameters, have a business plan, know what you're going to do, know what you're willing to spend, know what you're willing to invest, and work with your business partners, other co-owners and advisors, and have a plan and stick to it.
Yeah, and that's one of the things. This is such a great industry. And it's so good. It's so easy to get caught up in the moment and to start doing things. But I really encourage you to step back and apply the techniques that made you successful in your other business ventures, and think about the ways we see it all the time. Successful people get in this business, and then they've done this handshake deal, and Shannon and I are trying to struggle and say, wait a minute, you really didn't mean that. You meant this. And trying to help guide them after the fact. And so it's just a reminder that apply what you've learned in your other business ventures. Understand both the upfront investment costs and then ongoing costs as well, because obviously there's ongoing costs. Certainly maintain separate books and records. Keep any personal, any hobby stuff, any non-horse related items out of your horse operations. Shannon mentioned developing a multi-year business plan. I've put some information in the handout about how you can do that if you're racing, if you're breeding, what you could look for. Shannon talked about surrounding yourself with good business advisors, and I would second that, but also follow their advice. I've seen oftentimes where people...
It's harder to do sometimes.
It is very hard, where everyone, we're all used to getting our way and being in control, and sometimes it's hard to relinquish part of that control. But if you do surround yourself with good business advisors, you need to follow their advice, because if they've been in the horse business, and again, I'm focusing on good business advisors, not just people that, that may steer you the wrong way. But certainly if you trust the people around you, please pay attention to what they're saying. They've obviously been in the business for a while. And then also, not that the tail should wag the dog, but just understand the tax benefits that are available when you're purchasing horses or when you're in the business, and just know what you may be able to utilize and what you could benefit from. So, I think that's all we had for prepared comments. I guess we'll just open it for Q&A now. We've got people around the room, so if anyone wants to